From the American College of Financial Services, welcome to Annuity Insights, in partnership with New York Life.
Welcome to the Annuity Insights podcast. I'm Michael Finke, professor of wealth management at the American College of Financial Services, and I'm here today with our faculty member, Steve Parrish. Steve is a professor of practice in our retirement planning program and really an expert in all things at the American College. I'm also here with Jen Weiss. She's the head of third-party service experience at New York Life. And Stephen, I think we'll begin this conversation with you. Not only are you a professor of practice, but you've also worked at an insurance company as an executive for many years. Annuity products can be very complex. And if you think about the vintage of annuity products, there can be products that were created years ago that are no longer actually sold by a company. There are various types of annuity products, like they run the gamut from very simple annuities to RILAs and variable annuities with different riders. Talk to me about the complexity and what a insurance company can do to help an advisor wade through some of the complexity of these many products.
Right, because consumer perception of annuities is all over the map. You ask any consumer what an annuity is, and you'll get a different answer. And I sometimes run into that with advisors as well. So if you're trying to, decipher all this, maybe it's breaking it into its major areas. I mean, in other words, some products are there for growth, and frankly, it's whether we can call it one or not, it's an investment, tax deferred. But some are for income. So a lot of us think when we hear the word annuities, we think that somebody's paying us money back. And then you get into control. Who's controlling the investment? Is it variable, where obviously you get the say on where the money goes? Or is it participating in the market, which gets really confusing when you're talking about fixed index annuities? Are you participating, or are you just getting part of it? How's that work? Or with some people, it's a set it and forget it type of thing. In other words, I don't want to think about this. I want to play with the kids in retirement, grandkids in retirement, and so let the insurance company take it. So I think part of it is just making sure at the very macro level we distinguish what's the ultimate purpose for the annuity. Forget the names, but what are we trying to accomplish?
And how can a provider give consumers the kind of information they need to make effective choices? So Jen, how does that work? The direct to consumer angle from the perspective of the manufacturer.
It's a great question. And I think Steve hit on a few key points of the perceptions of these products are, all over the place, sort of run the gamut. And I think as providers, what we at New York Life and others have been doing is trying to figure out how can we simplify this? So yes, the products can seem complex, and it's a delicate balance of we want to differentiate our products, but we want to keep them really, simple to understand. But I think the easier that we can make it for clients to understand these products, the easier that we can make it for advisors to sort of explain the benefits of these products. That's where we've been, spending our time, is helping advisors to, fully understand the product, how it might compare to other products. And then when it comes down to making a selection, how can you be a provider that's also easy to work with, easy to do business with, provides transparency to the clients, to the consumers, has knowledgeable people there to help the clients, work through this.
Steve, when you worked at home office, what kind of questions would you get from advisors? What are the most common questions that you see, and how did you feel your role was in terms of supporting the advisor?
Right, because in so many cases, the advisor wants to do exactly that, be the advisor, and then kind of walk away from the ongoing things that make it happen. So just to give you some examples, I know Jen could give you many more of them, but if you bought a multi-year guarantee annuity, how are you going to find out about the renewals? I mean, in other words, is somebody going to tell you how many days are you going to have before you have to decide whether that fits? Or I ran into one personally just 2 weeks ago, 1099 reporting of a single premium immediate annuity. I kind of thought, wait a minute, I've got these payments coming in. Am I going to have to calculate that? And then I looked, and I got a perfectly done 1099 from the insurance company. I think a big one these days is the whole world of FIAs or fixed index annuities is trying to explain what you're getting credited in this period, if it's a year or whatever. And I'm just giving you examples, but one that people don't think about, because no one wants to think about dying, is what happens when you die with an annuity? How's it going to be handled? That's become a very interesting area. So when I was in a home office, those were the things that the advisor was expecting me to really have a system for so that they could go on and help the client with their financial needs, their retirement needs, not all these details.
I mean, that's a great point, Steve. In many cases, advisors may feel as if they have sold the product and they can kind of walk away from it. But it really does require ongoing maintenance, and oftentimes advisors don't know all the details of the product. And like you said, maybe not all providers make it easy for consumers. They provide them with a 1099 at the end of the year, or they provide them information about when they need to make decisions regarding their product. I think that there's probably a lot of variation, and there may be some incentives not to provide as much information on behalf of some insurance companies. What has been your experience been, Jen? It's one of those we oftentimes think about things like what are the rates that what are the cap rates and what are the income rates, and we don't oftentimes have conversations about the support that goes behind that product and how much easier that can be for the advisor if they're getting a greater level of support.
Yes, yes, and yes. I think that we often, when you think about making a decision, you look at the products, you look at either the cap rates or the other offerings within the product. But more and more service and the experience that a company provides is coming up in the conversation exactly for the reason, Steve, that you said. This is often a long-term relationship, right? If you're talking about some of our income annuities, can be a very long-term relationship, that the advisor and client are starting with the company. And so I think, from our point of view as providers, we want to provide advisors with confidence, right? Confidence that you've chosen the right partner and someone that is not only going to be here day one for new business, but end to end, right? So are there questions? And we want to have people that are here to help with those questions. We want to have sort of 24/7 self-service tools for meeting people basically where they want to be. And Steve, to your point on the claims, it is certainly, of course, not something that people think of at the beginning, but ensuring that, and this is a pain point, I think, for all of us in the industry, is staying in touch not only with the client, but their beneficiaries. And, if the product has been around a long time, making sure that we keep those connections going. So there is so much, I think, beyond signing that application that the advisor is like opening up this relationship with the company on.
Steve, we have talked about this topic before, and it is one of those topics that hasn't really received a lot of attention, but is a big deal for consumers. What happens when a consumer's policy is transferred from one insurer to another? And it does happen, doesn't it? And it can result in a difference in the level of service. And if it's below what the consumer expects, then it can create some issues for an advisor.
Yeah, and I think that's a very much top of mind issue these days because we know about the various companies switching to private equity companies buying them up and those kind of things. And so there's an expectation when you bought the policy to get a certain level of service, and then suddenly a company you never heard of, very much like the transfer of a mortgage to another company where you go, who are they and wait a minute, what's going on? So all I can say, Michael, is we have heard some horror stories. It becomes incumbent really on the advisor, whether they like it or not, that you're going to have to try to help clarify any service changes happen, just a name change, and going through those so that you can kind of prepare that client, because maybe for the rest of the remainder of that contract, the service will be different. And maybe that's something the agent picks up, but at least so they're aware of it rather than surprised.
Steve, I follow online forums of insurance agents, and this is one of those areas where I see a lot of consternation. I see a lot of agents saying, I will never, sell another product from a company because I expected a certain level of service, and I told my client they were going to get a certain level of service. It's one of the reasons I made that recommendation. And then it got sold to another company, and nobody will answer their phone calls. So it's an issue. It's a real issue. It's something I've given a lot of thought to. How can we actually reduce the likelihood, because it does become something of a business model. If you have a good reputation for providing high quality service, and then you sell and that's baked into the cost of the product, and then you sell that product to a provider that has less of a stellar service reputation, then you can actually make money, because maybe the advisor recommended the product because of the high quality service, even though the income rate was a little bit lower, and then it gets sold to someone else, and the insurer can essentially make a profit off of that, because part of that was baked into the price of the original product, and it creates a little bit of a market problem. Jen, let's talk about that. I mean, how often does that happen, and how often do you hear from advisors about this problem of seeing products that they've recommended from a specific insurance company transferred to another one?
Oh, it's tough. It's so tough, because you started this relationship with a company, and you were sort of expecting, as you said, a certain level of service. And when that changes, it's really tough on the advisor. It's really tough on the client. And there are deep impacts on that, right? I know there's different stats, different studies around the fact, Michael, you were just alluding to this, that people sort of equate product is top of mind, but they are willing to maybe sometimes accept a little less rate or pay a little bit more if they know the service is going to be excellent. So, I mean, we hear that from time to time for sure. I think, for us and for others, we really try to make sure that we're investing in the full sort of service experience, as we mentioned. And I think, as our demographic is growing older and changing, and annuities hopefully are becoming more popular, trying to make sure at least that we can meet our enforced clients where they need to be. So if they want to call us, we want to make sure that there are knowledgeable people here that can answer the phone. If they are more of a 24/7, they're doing business at night, we want to make sure we have different tools where advisors can check what's going on, clients can do self-service. So I think what we're trying to do is at least meet people and our clients, and I think our peers are doing this too, where they are and where they need to be.
So Jen, you say that there is a certain level of service expectation on the part of the provider. Steve, where is that line between the service that's provided by the advisor and this service that is provided by the insurance company?
Yeah, and I think that's one of the things you have to, as an advisor, think through what you will do. I mean, maybe you have a client relationship system, a CRS, to check up on things like, again, a MIGA coming up every few years for rate. Michael, one of the things I think that most advisors need to keep in mind is that in the area of taxation, you can only expect so much from the insurer because they don't know the individual situation for the client. And so when you're looking at things like, should I exercise a guaranteed lifetime withdrawal benefit or should I annuitize it? I'm not sure you really can look to the insurer to answer that question because they don't have all the data that you have. And if you're in a loss situation on a variable annuity, understanding capital loss versus ordinary loss, all those kind of things, I think really an advisor has to say, what areas am I responsible for in taxation? To me is an example of where maybe the insurance company can help give them education and guidance, but that's very much on the desk of the advisor.
As the baby boomer retirement wave crests, it's time to position yourself as the ideal partner for this growing pool of clients with the American College of Financial Services Retirement Income Certified Professional designation. As an RICP, you'll get the specialized knowledge to help more clients with complex retirement planning needs. With the convenience and flexibility of the latest in e-learning design, the RICP delivers applied knowledge from over 45 retirement experts on Social Security, taxation, income planning, Medicare and Medicaid, long-term care planning, and more. Get started in our 3-course program today and become an RICP in 12 months or less. Now is the time to strengthen your client relationships with deep expertise to address the unique challenges of retirement. See how you can expand your opportunities at theamericancollege.edu/RICP.
This is one of those questions that I've always wanted to ask Jen. So there are products like MIGAs where they may have a maturity date and then they may automatically renew if nothing is done. And there may actually be an incentive for a manufacturer to not remind people how much effort should go into that process of keeping track of these important dates on a product and reminding the consumer that they may need to take some course of action, and maybe even making recommendation about what that course of action could be.
100%. And of course, I think the short answer is it depends. Michael, in your example of, let's say a date is impending, and if the client doesn't do something by that date, reset, or, we have a strong sort of, I would say like legal team and others who would, help us figure this out. But I think, we would and should kind of go out of our way to make sure that not only the client, the advisor knows about those important dates, and I think sometimes those get missed, and we have a pretty solid exception place in process to figure out, like, did we miscommunicate or miss an opportunity versus maybe that there was inaction taken on the other side. So I think from our perspective, we take like a conservative approach on that, and I think we try to be over communicative, and most of that is through, I would say, like statements and letters. More lately, we've seen more usage on our website. So trying to send alerts and different things, letting clients know, hey, this important date is coming up. If you do or don't do something by this date, this is the implication. Very often our call team, our call center, is the front line for that, because sometimes we'll send those letters, and to your point about complexity, maybe a client or advisor couldn't fully grasp what we were trying to say in that letter. And I think our call center will help guide sort of what's coming up and what the implications are. So that's a couple of ways that we would think about it. And I'm just thinking, Steve, back to your example too with the taxes. That's a delicate one, I think, right? Like if someone called in and said, what should I do about this? That's a line, of course, that our service team wouldn't cross. But on the point of education, we do try to make sure, at least our wholesaling team, to get in front of advisors with different tax experts and different people, different third-party educators that at least can get advisors equipped to answer some of those questions that maybe we wouldn't.
Yeah, that's a great point, Jen. You also, we haven't really talked about the role of the wholesaler. Because I know a lot of wholesalers. I've worked with a lot of insurance companies. These tend to be very sophisticated people. They really understand. They've seen the most complex types of tax situations. Steve, we're going to have an entire session where we talk about tax implications of annuities. But the bottom line is that it's complex, and different products are going to have different types of taxation. For example, some products are eligible for an exclusion ratio. You might have a GLWB where taxation is kind of odd. It's fully taxable, then it's not, then it's fully taxable again. These are complex issues that need to be built into a client's financial plan. In other words, they need to know what the stream of tax liabilities is going to be, not just today, but in the future. And also at death, they need to know what the tax consequences are. And doing it right it requires a certain level of expertise that I don't think we can expect every advisor to have. So who provides that level of expertise and support to advisors just to make sure that they understand all the tax implications of the product that they're recommending to a consumer?
Well, I think another reason that's an important question, Michael, is because we have the fact that now, if you're going to sell an annuity, you're held to a best interest standard. And so part of it is you better figure that out in advance, because how you'll be measured, how you'll be looked at when the niece of the policyholder suddenly contacts you and says this was the wrong decision. At what you have to sort through, was that an advisor issue? Was that a wholesaler issue? Was that a home office issue? Obviously, I don't have the answer, but I would say that's a more important issue than it was as little as 5 years ago, because the standard by which you're going to be measured, the lawyer in me, is just saying it will be a higher standard than it used to be, where it just had to be suitable.
Yeah, Jen, I mean, when you think about it from the product manufacturer's perspective, what role do you see in helping the individual advisor make those recommendations that really are in the best interest of a client? They have to really understand their tax situation.
They do. They have to understand their tax situation, and they also have to understand what are the other choices that they had in this matter, right? And I think that's the trickiest part about this. Interestingly for us is, we have sort of two different distribution channels. And so I think we even have to think about it differently there. Like for our captive agency channel, our responsibility is much greater, right? I think it's suitability, it's best interest. And for the third-party advisors who choose to sell our products, there's this shared accountability across us as a product provider and the firm that the advisor is associated with. So that is good as long as everyone's clear on what the responsibilities are, but it's sort of like who's doing suitability, who's making sure that all options were considered. And while I think there's so much clarity after the NAIC rule went in, I think there are probably some questions around that.
So, Steve, what were some of the arguments in favor of the NAIC rule, and do you see this as an improvement in the industry? Is this something that, obviously advisors need to be aware of it. I'm sure the home office is very aware of it. What are some changes that you think are going to occur because of it?
Well, I think where the NAIC was trying to go with that, and by the way, my understanding is now all of the states have adopted the NAIC standard or some version of it. So we are working on a common standard, which, by the way, was a frustration in the past because it was all over the place. Really, you could almost call it, if you're the client, you have more than one throat to choke, meaning that it's a shared responsibility. As Jen points it out, it depends what the contractual relationship is between the advisor and the insurer. But still, at the end of the day, the NAIC is saying we really need to know that more than one party looked at this and felt that it really was, with the facts you have, in the best interest of the client versus, was an annuity and people like annuities, that's suitable. So I think it's been a positive in two ways, in that one, it's more uniform across the states, and two, it really is more tracking with other financial products such as investments, which by and large are being held to a best interest standard. So you get some commonality of expectation for the client. Is just because I'm buying an annuity, I won't be held at a less stringent standard than if I bought an investment.
And it really makes it seem as if that relationship that you have with a wholesaler becomes even more important, because you need to have a sounding board, someone who has seen many different types of client situations, who understands the products in and out, who gets the tax implications. So, Jen, what does that mean from the perspective of the insurer when it comes to training wholesalers?
I think the expectations on our wholesalers across the industry just continues to grow every year, right? Like, no longer can they be the annuity or the product specialists. They have to know taxes. They have to know best interest. And so I think that is sort of like a shared experience. As we mentioned, we try to educate our advisors. We're triply trying to educate our wholesalers on how the industry is changing, what do advisors need, and where can we really lean in and add value.
It's so interesting you say that, because I heard a few years ago that, in today's world, increasingly wholesalers were becoming less essential. And what sounds like is happening is that actually it may be the case that because of increasing complexity of taxes and products and best interest standards, that actually wholesalers, their job might be getting even more important. And you have to sort of weigh, if you're an advisor, the relationship that you have, the competency of that wholesaler, because they're a partner with you, and they can actually, if you don't get good advice from the wholesalers, that can actually be a risk for you.
I think that's right, Michael. It becomes more of a consultative approach, and I think as long as wholesalers are evolving that way, and not coming in with the flavor of the month, I don't think and we couldn't do that anymore. But as long as it's a consultative approach, you're sort of taking a broad look at the client's needs and then offering your suggestions and your help, I think their role becomes even more important in that way.
Especially as RIAs become more a part of this, so they're not expert in this, they're not an insurance agent in the traditional sense. Somebody has to fill that role, and I think of that very often as a wholesaler.
That's such an interesting point, because you're seeing an increase in popularity of firms that provide insurance services for RIAs and compensation. But that if the RIA is going to, they already have a fiduciary standard. If they're going to make recommendations that are in the best interest of the client, they may have to rely on the wholesaler even more than a traditional insurance agent does. It's something I hadn't really given much thought to. So Steve, some annuities have a very long shelf life. For example, if someone 65 buys an age 80 DIA or a QLAC, nothing happens for 15 years. How does a provider stay current on the location and the status of the annuity owner?
Well, there's a lot of cases that would suggest they don't always, and these turn into some many interesting interpleader cases, as Jen knows. You don't want that, obviously. You'd like to retain your client after your client's gone. You'd like to still work for their family. I really think it comes down to what the agent's CRS system is going to be, how they're going to keep track of it. Certainly, you want the backstop of the insurance company to help you. But I think the simple reality is you're going to have products coming from different companies. You have to be able to track that. I really do think that's become a responsibility, because otherwise you buy a QLAC and it's going to be 15 years before anybody even thinks about it. So helping the client get that in their estate planning documents, more and more people have vaults that keep track of things that they need to know at death. That's really become part of what a lot of advisors do, whereas before the advisor was the product person and then they walked away from it. I don't think that works anymore with these more complex long-term annuity products that look and smell and taste much more like a life insurance product.
So Jen, I mean, this really is a long-term relationship that you have when you buy a product, especially one, I mean, this is unusual, but this is happening more and more, that people are buying a product that doesn't do anything for a decade or more. So you're essentially relying on the service of the insurance company and of the agent maybe a decade or two in the future. It may be something that people don't give enough thought to. How do you ensure that a client who buys a product today is going to get a good experience 15 years in the future when they actually have questions about how to use the income?
Great question, Michael. And I think your question kind of takes me in two directions, one more immediate and tactical and one more addressing the future state that you mentioned. So I'll hit those both quickly. The first one is, as Steve mentioned, hopefully the advisor is keeping track of the clients and sort of life changes and address changes. But, we do feel onus, I think, as a product provider to do that as well. So, we send out statements and different things. And as I mentioned, I think now digitally we have more and more opportunity to kind of ping and alert clients to say, hey, like you haven't mentioned your beneficiaries in a while. Like, has something changed there? We have a pretty rigorous return mail process to make sure if they've moved, we got to find out like where do they live now. So it's sort of like a very like in-year tactical approach. But I think maybe the broader part of your question is we are earning clients now that will be with us 15, 20 years from now. And, sort of at the heart of why we're evolving is like the world is evolving around us. So I'm on Amazon every night, at midnight ordering things that I'm like, they better be there when I get home from work, right? Like our consumer expectations have evolved. And I think those consumers are the same people buying our products. So what we are trying to do also is like invest in our teams, not only from a tech, so we have to invest in tech, right? Innovation is key. People want to have that, that experience everywhere. But also in our people and making sure that they're growing and evolving. And even when we can, providing that more consultative experience. So I think it's twofold. I think we're trying to keep track of people best that we can, but also make sure that we are growing and evolving ourselves for the future.
Jen, you make a really good point about technology, that's an investment that the insurance company needs to make, and it provides, especially for today's consumer, a big source of value. And something an advisor can do is actually jump on the technology of the insurance company and see how much of an investment they've made in enhancing the consumer experience. When they decide that they're going to buy a product, how much information can they get online? Another great point. So many interesting angles in our conversation today. Thank you so much, Jen. Thank you so much, Steve. And thank you, everyone, for joining us for this episode of the Annuity Insights podcast.
Thanks for listening, and we hope you join us on future episodes. Annuity Insights is a production of the American College of Financial Services. Annuity Insights is produced and owned by the American College of Financial Services with generous support from New York Life Insurance Company. Accuracy of information is subject to change, taxes, legal, rates, etc., but believed accurate as of the time of recording, January through April 2025.